Well, look who wanted to come say hello. Coco herself, running today's stock market beef episode. Got a lot of weird things taking place in the market. Yeah, I got a new camera set up, still sitting at my office, getting ready for some live streaming in the new year. We got a lot to discuss on today's Stock Market Brief Show. Wasn't here on the weekend, but we're going to go over the weekly expected moves for the S&P 500, go over many different indicators and some stuff that's going on in the market that I just find to be quite odd. Let's get into it. Welcome back, everybody. So one thing I want to start off here with is that risk happens incredibly quick in these markets. So the reason why I'm calling all this stuff out is because if we can get ahead of it, and if something does happen, if something does break within either the financial markets, credit markets, whatever the case may be, there are always good opportunities to come from it as long as you're aware of what's been taking place and you're prepared for it. And that's what we do here on the Stock Market Brief Show. We like to be prepared for potential changes in trend or events to occur in the market. And I'm starting off this episode looking at the Fed Watch tool. The Fed Watch tool is the Fed Funds Futures. This is a tradable product, billions upon billions of dollars, right, is traded. And what they're pricing in here to me is very odd. They are looking at rate cuts starting in March, which is, basically saying, yeah, the Fed says one thing, we say, nah, I don't believe you. I'm not taking you at face value. Higher for longer? Nope, something's gonna happen. And I'm looking over here. This is where we're currently at, right? 525 to 550. And the next two next two meetings, right? So December and January, there's a high probability that they keep rates where they are. All right. However, if you go right into March of next year, there is over a 50% probability of a 25 basis point decrease. And then now there's a 7% probability of a 50 basis point decrease in the rates. So this is telling us that the rate hike cycle is over and it looks to be coming into a rate reduction here very soon. And if you add these two together, right, you have almost a 60% probability that we are going to have rates cut then. You go out to May, which is not far, right? You're looking at 45 plus 30% probability of a rate reduction, a 30% probability, right, that we're going to have a 50 basis point clip. And then over here, we have almost a 50% probability. So the likelihood of getting rates cut even more into May, and you could see even more as the time goes out. So this rally could be pricing in. It could be discounting what the Fed is going to potentially be doing. And that's what we're currently seeing. That's what I find odd, because what happens when they typically reduce rates, it's not always the greatest, especially where we currently stand. And where we currently stand, we have this deeply inverted yield curve, right? It's getting kind of uninverted, right? We're at about 36 basis points of inversion. The 10-year 3-month yield curve, we're over 100 basis points inverted. And when these uninvert, from what I've seen in the short period, dating back to, July of 2022, when we went into inverted territory, when we go deeper into inversion, the market actually likes it. You go deeper into inversion, the market rallies, deeper into inversion, market rallies. This recently drop in October of the yield curve getting deeper into inversion, what happened? Well, the market actually enjoyed that. They rallied. But the reality is we can't sit here with a inverted yield curve forever. It will uninvert. So does that mean the market's going to potentially get hit? Well, if we take a look here at the 10-year 3-month, right, this is a very deep inverted yield curve. And I know a lot of people are saying now it doesn't matter, but the reality is it has always mattered when they become inverted, because it has been the best predictor of a recession up ahead. Now, what that means for the financial markets, I don't know. I can only show you what has happened prior. Okay. So this is where we are now. This was the 2020 recession, right? This is the great financial crisis. This was the dot-com bubble. This was the 1990 recession. So we're deeply inverted, dating way back through the 80s. Now, if we take a look at the 10-year 2-year, I'm kind of jumping between curves. You can see we're inverted. We were inverted over here in the great financial crisis. We're inverted here in the dot-com area too, the 2000s, okay? And these are all getting inverted after when we started raising rates, right? We started raising rates, they get inverted. We started raising rates, we got inverted. What you'll notice is when we get uninverted, and the rate cycle starts dropping, there's typically something that breaks the markets. You can see if you just go right up, right? Go right up. Well, what happens here if they don't hold them higher for longer and we start doing what the Fed Funds Futures is predicting, we're going to start reducing rates? Is that going to be bad for the markets? And the answer is, I don't know. But what we do know is what history has told us before is we don't need to be surprised if something were to happen, right? So this is how you prepare, is just by looking what has happened throughout history. Now, some other interesting stuff that I found was financial distress leads to surge in early 401k withdrawals. So Fidelity reported that there was a record of hardship withdrawals in 401ks. You can see here in Q3, 2.3% of the workers took hardships withdrawal, up from 1.8% in Q3 2022. Top two reasons behind the uptick were avoiding foreclosure and eviction and medical expenses. So that's not something you really do, like, if the markets are going really well and everyone's having a grand old time, which kind of seems like is what's going on right now. At least that's kind of the sense that I'm getting. You see unemployment rates can kind of uptick, and this is a very lagging indicator. We do have unemployment data coming out this week, and we also have some ISM numbers, some jolts. We got a lot of macro data that can really shake up these markets, and I'll go over those key levels and what to expect moving forward. But it's not only does the unemployment rate kind of moving itself up a little bit here, and we got a new report coming out soon. Personal savings rate has been dropping, so unemployment's been going up, savings rate's been dropping. Very just strange behavior when we're seeing very bullish type euphoria. And what I mean by that is if you look at something like the fear and greed index, right? We're up here back up at greed. When we get into the extreme greed areas, it can mark turning points in the market. When we get to extreme fear, it can mark potential turning points. Goldman Sachs showed their US panic index, and it said there's effectively zero panic priced into the markets dating back all the way to 2022 here. You can see we're at the lowest reading. If I look at the AAII bears, right? This is, where are the bears? They don't exist. They're gone right now. And if you also look at things like, skew, and you look at just put option contracts, how really cheap that they have been getting, especially with volatility coming way off and the markets rising like this. So there's effectively no bears as it stands right now. Gold also, very strangely, this is a typically, run for safety type asset, just hit all-time highs. So we got all this strange stuff going on. And what is gold signaling to us? Hitting an all-time high, but we just saw a massive reversal intraday, just engulfing this prior trading day candle. So we'll see what follows through with that. But, all-time high, it's, a long time, right? Gold's been around for a very long time, and we just recently hit an all-time high. If you take a look at oil's down for its third trading session in a row. It's right around about 24 to 25% to the downside from this prior high. And you can see we talked about this rising wedge structure, bearish structure, and we said it probably come back down to the 200-day. And we've been struggling since we broke it to get back above and hold it. Now, I don't think this could very well be pricing in a recession, right? However, I really think that would have to start breaking some other key levels to really get a little bit more bearish there. But overall, that's a pretty rapid drop in the price of oil in a short period of time. But you wouldn't notice this because what's strange is, the market's been going effectively straight up, right? Yeah, we're kind of going through this weird choppy consolidation right now, but effectively we've been going straight up. MACD's curling over slightly over here. You have the Dow Jones Industrial Average, right, just completely skyrocketing. The RSI reached its highest, point in like 5 years, up there at its upper Bollinger Band, way disconnected from the 50, 200, and 20-day moving average there too as well. So just effectively straight up, zero fear in the markets. Financials, look at financials. We're just seeing just, another thing that's just effectively straight up, despite having this yield curve inversion. And this, this to me is not normal, healthy market behavior at all, especially with a low VIX and positive gamma territory where you typically see, slow grinds up. But we've been seeing just monstrous squeezes. Take a look at real estate, also a rate sensitive area, just been completely just going vertical. Bitcoin, also another one going completely vertical. This is the Sailor to Shift tool. This is one of the indicators I just absolutely love to use. I personally believe that this is the best indicator for finding turning points in the price of Bitcoin, and that's by mapping out the 4-week rate of change between Bitcoin and gold. I have my own specific strategy. I know other people that created theirs. but it's caught this run up right here. It's caught this sell off. It's caught every major sell off. And the recent one was over here where it went onto a buy signal. All right. So there was a signal that was triggered. And then you had the trigger, right? The trigger is something different. You'd have to watch the video. And we effectively went up, and you could see the market just been completely ripping. However, the rate of change is coming off. So if we start crossing down through that zero marker, the zero marker in the rate of change between Bitcoin and gold, and then we get below the prior weekly low candle, that will be an official sell signal. And I'll be talking about it on the show if that were to occur here, obviously in the near future. I'm starting to see a lot of rotation, okay? And the Magnificent Seven names relative to the S&P 500. Like Meta was down pretty brutally to start the day. Apple, right? Nvidia, Google, Microsoft, Amazon, Tesla, right? I put Netflix up here, but what you're seeing here is the lines are going down, which means in recent trade, these magnificent names, right? The big mega cap names are underperforming the S&P 500. So Google broke down from the 50 EMA on this relative strength line, and it's been cracking lower. Meta cracked down from it. Nvidia cracked down from it there too as well. So these are all something that you just need to be aware of, because there are names that have been squeezing, right? A few episodes ago, we talked about a lot of different names. Carvana, NVNX, right? We said those look really prime, and a bunch of other ones, and those things squeezed like crazy. Take a look at BPSPX chart. The RSI is getting crispy, right? Very fried up there. It's right at about 70. So this is where it gets interesting, is when it gets above the 70 and it crosses back down, right? So we've called this out. It went up. We crossed back down, and that's when we saw that weakness in the market. We've seen it multiple times. We talked about the BPNDX chart with the negative divergence it's forming, something to be aware of. Here's a chart I haven't showed for a minute. This is the percent of stocks above the 50-day moving average. So 85% of the stocks in the S&P 500 are above the 50-day moving average. And you look back through history, well, when we get to these extreme levels, you can typically mark turning points, periods of consolidations, or pullbacks in the market. And you could see that's happened here, just dating back to 2 years or so. And you take a look, this is the percent of stocks above the 200-day. It's not really an extended reading. You can see 67% of the stocks in the S&P 500 are above the 200-day moving average. And, when we reach to these, higher levels, that's where we can potentially see pivot points there too. If I take a look at the percent of stocks in various different index products above the 20-day moving average, the S&P 500 has 87% of the stocks above it. And this is, overextended reading, and it oscillates really kind of between overbought and oversold as the market makes its moves. You can see small caps, almost 90% of the stocks, right, are above their 20-day moving average in the SP 600, which is a small cap index. Mid caps, same thing, 89.75%, 88% in the SP 1500, and then so forth. The Dow Jones, 90%, right? So we've been getting monster squeezes there. And, if you look back to the left, it hasn't happened, it got these extended readings for quite some time, right? It's been multiple months. Another thing to note is back month versus front month volatility still remains right at about that 20%. So more risk into the future than there is, as it stands right now. So we're looking at 20%, right? So it's basically telling us that, 3-month volatility is 20% higher than front month volatility. And when this has happened, you can see that when we get this yellow line up in these areas, it's marked periods of consolidation. So when we got up here, we said, can mark turning points or periods of consolidations. Well, what's the market been doing? Market's been consolidating. You can see over here, it happened too. We pulled down. Over here, we went through multiple periods, a long consolidation before finally pulling down and breaking out. We got way up again, and we went through kind of this consolidation before eventually falling over there too as well. I want to show this chart, the dollar, the 10-year yield, the S&P 500. These have been right here and right here, the two assets to continue to watch. And they're still, in my opinion, have the potential to go higher. So be aware of that, because when these go up, what happens to the S&P 500? It has gone down. Now, I don't think many people are expecting the 10-year yield to all of a sudden, make a move, right? We're currently, breaking down from this head and shoulders pattern with a target about 4 to 4.1%. But the price action here is still coiling up, getting tight. And if we break out to the upside, that could spell out some drama for these growthier names and also the S&P 500. And then the dollar, I mean, I could look at this as a tight wedge here that actually already broke out. We're kind of within this channel now, right? We're testing this area of resistance, had a good update today. Well, what happened with the 10-year yield was up, the dollar was up. What happened to the S&P 500? Well, it had some weakness, right? But overall, we're just consolidating and coiling up within this rising wedge structure. So when do we get a little bit more concerned? Well, let's take a look and be very tactical at the lower time frames. This is what I always like to do to prepare us and get early for a potential change in trend. Now, this purple line, magic purple line over here, is the 5-day moving average. And you can see it is actually still inclining. But because price action has been going sideways, it went from an incline and now it's starting to flatten out. And if you know, market structure moves between 4 different stages. It goes through accumulation, goes through markup, goes through distribution, and it goes through decline, and then back to stage 1 again, accumulation. So if this was the incline phase, this could be the distribution phase, which feels like that with these heavy volatile swings. Now, when do we get more concerned? When we get more concerned is when we get below the 5-day moving average and it starts rolling over and holding as a level of resistance. That gives us an early indication that the trend may just be changing. Okay, I personally trade a lot of breakout names. I'm a swing trader, currently getting into, recently got into futures trading for more intraday type, but mainly I am a swing trader. And what I know when I trade breakouts is that if we are below a declining 5-day moving average and I'm looking at a price action that's tightening up, coiling up, and I want to play it to the outside, I get a lot more names that fail my breakouts, right? Because the S&P 500 is the mega product. This is the big dog product, and it controls a lot of flow in other names. So when this thing, gets hit, it takes down many other names despite seeing bullish structures in them. So one, I like to look to see if we're above a rising 5-day moving average. I like to see it rise. And guess what? Been killing it this last month. A lot of names have been breaking out. If you go into my Patreon community, right, you can go through all the names, right? There's been a whole bunch of names that squeezed up higher and played, but you got to be aware that, hey, when we get back below the 5-day moving average, you got to be bearish, but with caution. And you become more bearish if price starts rolling over. That doesn't mean short if you don't know how to short. It just means just be careful, update your stop losses and so forth, right? Interpret it how you want to interpret it. The next big thing that I want to watch is the gamma flip level. The gamma flip level, this will change the market condition. This is a big one because this is where you get a lot more volatility. Okay, so this is how dealers are positioned, how dealers hedge. And right now we're in a positive gamma territory. That's a check mark, that's an A+, right? We're good there for the bulls. We're above an inclining 5-day moving average. Check, that's good for the bulls. All right. So what happens if we're below a 5-day moving average? Well, that could be, bearish with caution, but we're above the gamma flip level. Okay. Like I said, bearish with caution. But what happens when we go under the gamma flip level and we start breaking down with severe volume to the downside? That is when dealers will sell into selling, creating much more volatile moves. Okay, that level is 45.40 on the SPX. So right now it's above it. So that's a positive sign. This level does change as the structure changes in the markets as well. Now, what happens if we stay above it? This is where volatility typically subsides. And we've seen the VIX come off, but we've been seeing a lot of intraday volatility, okay, mainly controlled by zero-date flow. And what happens within this environment is when, dealers look to sell into strength and then they buy into weakness. And it causes this back and forth, slow grind up higher. And that's kind of what we've been seeing here. So watch out for this break. Now, this is also right by the weekly expected move. That's 45.37 on the SPX. The daily expected move going into tomorrow is 45.47. You can think of these in terms of a distribution curve. 68% of the time, they close within it. Now, want to know something crazy? If you want to see trend days or pretty wild days is when we open outside of these daily expected moves. So today, the daily expected move, the lower level was right here. Okay, just at about 45.70, it was just right here. We opened underneath it and it just pushed us lower. All right, so what that tells me is that the market was saying, hey, I think the expected move, for risk is going to be around this range. That's what we're pricing in. If we get outside of it, what has to happen? Dynamic hedging. And they're like, oh, we were wrong. Price pushed down severely on that. And then we came back, right? Boom, boom, boom. We started pushing right back up into that level. As we know that the probability, 68% of the times, if you think of it in terms of probabilities, it closes within there. Now we close outside of it ever so slightly, but you can see that was a very key level. So going into tomorrow, 45.47 to the downside, 45.91 to the upside. And then I have some other lines on my screen. These are spot GEX levels, spot gamma exposure levels, so they can be important ones too. So 45.50 is an important one. 4,600 has been a key call wall level, all right? And price got rejected from that level. We've been talking about that for a long time because that has been the bigger level. We are still well within the weekly expected move. It's been only one day. We almost tagged the lower weekly expected move. If we get back below this low right here, back below the 5-day moving average, that opens the door for the lower, and it also opens the door to come test that gamma flip level. As I've already stated, there is a lot of overbought conditions in the market. As we have all this building up over here, a lot of pressure in the markets just kind of coiling up. It's contracting, going one way. Just be careful that if we start to get sectors to break, it's going to be hard for the S&P 500 to hold up. The reason the S&P 500 has been holding up so well, despite seeing the weakness we previously stated in the Magnificent Seven, is because of names like financials. Financials really held this up together. And then also energy has been kind of going flat, and that has been kind of holding the S&P 500 in a steady pace. Now, if financials start to get cracked, just be aware, right? This could really bring down the S&P 500 if the tech names go with it. This will take down the Russell, right? There's a lot of financial names within the Russell, and there's also a lot of energy names within the Russell. So if you're looking to hedge some bets or look for cheap insurance, you can look for various puts. You can look to short, strong, moves like this. When it comes to me personally, when I short, I do a very small position. It's typically half of what I do for my max long position, right? So if my max long is 10%, the most I'll go max on a short position is 5%, okay? Because if I'm wrong, they can blast off in your face. I've been very tactically short multiple times. I shared on Twitter, and it's worked out perfectly fine for me. I shorted semis, I shorted the Qs, I covered that today near the lows, and I've looked to get back in short. I'll probably use, because I can't short in my main account in my IRA. So I look to go long like FAZ, and I have to even go smaller position because it's a leveraged product. So that's kind of what I'm thinking. I want to close off going into, just a thought that I had the other day. And that was really to kind of closing the gap to become a better trader. And I was realizing, somebody was asking me a bunch of questions, and I was like, you know what? I have an easy way to illustrate, closing the gap. I feel like a lot of people, they know, right? So a lot of people over here, right? We'll just label this little bar over here, things that you know, right? And typically people know everything that they need to know about trading, right? Or they know exactly what they need to do in order to become a better trader. Maybe you don't know how to read charts. Maybe you're learning how to do that, and that's what you're doing. Maybe you know how to read charts, you know how to do all that stuff, but yet you're still not a consistent trader. Well, there's a gap, right? This gap right here to this other, we'll call this, area over here, what you actually do. Okay, so this over here is what you do, and this is what you know. And the farther away from, these two are, the bigger your gap is and the more inconsistent of a trader you are. So the goal here is to take everything that you know and what you need to learn and then actually doing that. If you know you shouldn't be YOLOing positions and that's what's been hurting your portfolio, you know that, but yet there's a huge gap, bring this in and make the gap a lot smaller, because that right there will help you be a more consistent, profitable trader throughout time. That's all I got for you on today's episode, everybody. Hope the little nugget helped you out at the end. See you later.